Hey guys, welcome to Aetherium Capital. Today I'll be going through the recent 13F filings by the Superinvestors. For those of you guys who have no idea what the 13F is, the 13F is basically a SEC requirement for investors that are managing above $100 million to actually submit their buys and sells every quarter. So every quarter basically means every 4 months or every 3 months, the investors will have to disclose their holdings. So for those of you guys who actually want to look around for good companies to invest in, one of the things that you can actually do is to look at the positions that they are buying and actually form the own thesis for the companies that they bought. So the important thing is that you shouldn't buy and sell based on what super investors bought and sold. You should look at the stocks that they bought and basically try to form an investment thesis of yourself and have the conviction of holding through it, even if some of them sell their stocks. So let's look at Lilu first. So for those of you guys who have no idea who Lilu is, I would really recommend you guys to actually read up on him. He's a legendary investor, and his background is extremely good and extremely insane as well. So I'll just give you guys a brief summary on this. Lilu is actually from China, and he was actually one of the students who actually organized the Tiananmen Square massacre. So the Tiananmen Square massacre, what happened was he was one of the student leaders that actually organized the protests for students at Tiananmen, and what happened was the China government basically shut them down. And he fled to Taiwan, fled to North America, went into the US, studied in Columbia Business School, and then in the end managed to become extremely successful with his portfolio. So his background is extremely amazing, and his investment philosophy is great as well. There are a few lectures that he gave online that I will actually put in the link in the description below because I found they were extremely informative. And if you guys want to look at them, just feel free to look at those videos. They are about an hour, some of them are 2 hours long. So let's look at his movements. So first of all, let's look at this portfolio. It is extremely concentrated, as you can see. He has around 26% of his portfolio in Bank of America, 21% in Berkshire Hathaway. Google adds up around 34%, even though he has reduced about 19% in his GOG shares. So one of the interesting things that I would tell you guys is that this over here, this portfolio is actually not his overall portfolio. So Lilu likes investing in China. So he has quite a lot of position in this China. So this $2.2 billion only reflects his US holdings. So the high concentration over here, right, is actually misleading because it is a high percentage of his US holdings, but for the overall holdings, it is not as high. So I don't have a full picture of how his overall holdings look like because he doesn't have to disclose those. So I would say these bets over here probably are quite sizable in his portfolio, but it's not as concentrated as people think. So now let's look at the other investor. You have your Dev Kantesaria. Dev Kantesaria basically invests in high quality companies that have low capital expenditures. So capital expenditures are basically the amount of money that companies have to deploy. And Dev Kantesaria actually likes to invest in what is known as capital light businesses that are money generating and do not require a lot of maintenance expenditures. So Valley Forge Capital under Dev Kantesaria has actually returned nearly 15% since inception in 2007, and it has beat the market by 5 percentage points in a year. So Dev Kantesaria portfolio is another one that's extremely amazing. If you can see over here, it is extremely concentrated. This over here is fully in US. So Dev Kantesaria is basically a manager that fully concentrates in his portfolio in the US. So if you look at this concentration, it's quite insane. 32% is in FICO. So obviously, Dev Kantesaria did not purchase 32% of FICO. What happened was that FICO's returns were extremely outstanding and it has grown to a sizable position. And as you can see, he actually did not cut FICO when it reaches a certain percentage. So there's a lot of things that investors like doing, and one of the things is that they like to cut the positions when they get too large because they believe that it becomes risky. However, you have to think of it in another way. The reason why the investment became extremely large in your portfolio is simply due to the fact that it has grown a tremendous amount. So you have to ask yourself, did the intrinsic value of the business actually grow in line with the stock price? If it did, there's no reason for you to actually sell. So selling a good business and buying other businesses is like cutting your flowers and watering your weeds. So obviously, what we want to do is to preserve the flowers in our portfolio so that our overall portfolio will do well. And it doesn't make sense for you to actually sell the good things in your portfolio to buy the things that are bad. So this thinking and this management philosophy has enabled Valley Forge Capital Management under Dev Kantesaria to outperform the market. And if you look at all of his businesses, all of them do not require a lot of capital expenditures. Visa, Moody's, MasterCard, S&P Global, FICO, all of them are companies that do not require high capital expenditures. And if you think 50 years, 100 years from now, it is extremely likely that all of these companies will still exist and still do well. So honestly, for me, I believe that Value Forge Capital Management is absolutely amazing. And for me, I would love to own all of these positions. However, the main issue right now is that most of them are extremely overvalued. MasterCard is at a P of 40, Visa is at a P of 35. It does not make sense for me to enter now. The time where Dev actually entered them was extremely good. In 2011 or 2014, Visa and MasterCard had debit crisis rating. So what happens was there was certain uncertainties in their business model. And what Dev Kantesaria did at the point in time is he basically loaded a lot of money into Visa and MasterCard in a period of a week. Same thing for S&P Global. S&P Global, he managed to enter it during the 2008 financial crisis, where everyone was blaming them for the mortgage housing crisis issue. And he managed to add a shit ton into S&P Global. So personally for me, I'm just waiting for this 20, 30, 40, 50% drop in these companies. It could happen, it may not happen, who knows? I mean, look at United Health, it dropped 50% in a month. So anything could happen in the stock market, and I'm waiting for this opportunity to actually load up on these companies. So personally for me, Visa, Moody's, MasterCard, S&P Global, FICO, they are all too overvalued, and it does not really make sense for me to enter right now. Now let's look at the famous investor, Warren Buffett. Warren Buffett, there's nothing said. It is extremely amazing. He has compounded 5.5 million percent. So this is in comparison to 39,000 compared to basically the S&P 500. And the surprising thing is, if you look at the returns on an analyzed basis, Buffett's is 19.9% vs 10.4% of the S&P 500. So you may think, oh, that isn't great. It is like 9% more every single year. However, what you have to know about compound interest is that it is exponential. This 9% over a period of 60 years lead to this disparity in the percentage return, 5.5 million percent vs 39,000%. So I mean, this is why it is important to do well in the markets and try to beat the S&P 500. So if you actually beat the S&P 500 by 1, 2, 3% over a long period of time, you will be able to do extremely well compared to the others. So one of the important things to do well in the stock market is to actually enter at a good price. It doesn't make sense for you to buy a company that is extremely overvalued because the expected return in the future will actually decrease as the stock price increases. So what you will have to do is to wait for the opportunities where there is a downturn in the markets, where everyone is selling, to actually enter so that your expected return is higher in the future. So I'm sure most of you guys in the Telegram group would know they are actually added into United Health positions at $250 at 40 shares. So obviously, it has been a good run for because from that position up to now is up around 25 to 30%. And this is basically an example of buying when other people are fearful. And honestly, even though the United Health position has dropped from $400, $600 into now, I believe that it will rebound in the future. So obviously now let's go back to the topic. I'll create another video on United Health in the future. So let's look at his buys and sells. So Warren Buffett in general did not really buy much. He did not really sell much either. Overall, he is basically almost stationary and plateau. He didn't really do much. So if you look at his Bank of America, he's been reducing. His Davita has been reducing. And the interesting one is that he bought Constellation Brands as well as PoolCorp. So I have done some research on these two companies. Constellation Brands, one of the shining light in Constellation Brands is actually its Corona business. So Constellation Brands actually owns the beer bottling and basically beer production of your Corona. So Corona Light, etc. is extremely popular everywhere in the world. So Constellation Brands, I'm actually thinking about it. However, I do not really see how it would be able to grow at a significant rate over a long period of time. So brand power is important, but it is also very weak. So if you ask people what people are drinking about 5, 7 years ago, it was Anheuser-Busch. Anheuser-Busch, basically everyone was drinking it, but it has now shifted and pivoted to Corona instead. So this type of trends, tastes, and preferences, they are always constantly shifting, and I don't really see the competitive advantage of Constellation Brands other than the branding power currently. So another business is your Pool Corp business. Pool Corp is actually a company that helps build swimming pools and sells maintenance supplies for swimming pools. So what it does is basically 65% of the company is actually recurring revenue. So what this means is that it is a subscription, it's almost like a subscription-based business where the maintenance contractors actually buy chemicals from pool corp so that they are able to offer their services to pool owners to maintain the pools. And pool also has a portion of the business that is actually building the pools themselves. So obviously, pool corp is extremely dependent on the economic outlook as well as the interest rates of the economy. If the economic outlook is bad, there's a recession, there's no one that is building pools at the backyard. And also, when interest rates are extremely high, there's no one to actually finance. No one is willing to finance their pools at a loan that is like 6% loan. So it doesn't make sense to build pools in a high interest rate environment or in a recessionary environment. So this makes me a bit confused because Buffett is adding a shit ton into pool currently. So this means that he is probably thinking about the fact that there could be an economic recovery, and I'm not really too sure about this his reasoning of entering into pool. It is a interesting company. It is a decent company, but it is not a company that I would personally add into my portfolio simply because of its cyclicality. Next, let's look at our favorite investor, Bill Ackman. So Bill Ackman is quite a interesting investor. He started as an activist investor, which basically means that he went onto boards of CEOs and kicked CEOs out, changed directors, etc., so that they can restructure the company and make it better. So Bill Ackman of Pershing Square Capital Management, he has done pretty well at the start. However, over recent years, because of poor performance, his actually analyzed performance is below the S&P 500. Year to date, it's dropped 15%. So let's look at his buys and sells. So recently, what he did was he actually closed his Nike stock position. And instead of having the Nike stock itself, he bought in the money call options, a leap basically, which means that it expires after around more than 1 year later. And he bought into Uber instead. So Uber is an interesting bet. For me personally, because I believe in Tesla's vision, I do own Tesla, even though I dislike the valuations. Uber is probably a company that could be disrupted by Tesla. So the thesis, I read the thesis on Uber by Bill Ackman, is that it is a distributor. So what it is that it basically offers a network of drivers as well as customers. So all of the different companies would likely partner with Uber instead of taking over Uber. So for me personally, I don't see it. Uber Technologies is something that I believe is a commoditized product. You have different drivers, such as in Singapore we have GoRide, or we have Lala Move, we have the Gojek, etc. I don't see the differentiating factor between Uber Technologies and the other companies. So personally, for me, it is not a buy. Interestingly, he added into Brookfield Corp. Brookfield Corp is a company that I feel a bit iffy about. So obviously the manager is an efficient capital allocator because he has been purchasing a lot of energy and nuclear since 2016, and now due to the data centers boom in demand for energy, it has increased the profits of the company significantly. However, it is trading at a valuation that for me is not palatable. And for me, Brookfield Corp is something that is hard to understand and hard to analyze. And the future cash flows are all dependent on basically the DCs continuing to consume a lot of energy. So for me, Brookfield is maybe a too hard call, honestly. So the rest of the cells, he sold Alphabet as well. This is for me a bit strange because I'm sure most of you guys know that Alphabet is currently one of the core positions of mine. And what is the weirdest thing is that he actually sold GOOG and he bought GOOGL. So for those of you guys who have no idea what the difference is, GOOG is basically the Class C. Class C shares basically have voting rights. GOGL does not. So basically, what it is, right, is that he's selling those with voting rights and buying those without voting rights. So one of the possible reasons that he could be doing this is because of the fact that there's a price disparity between the two. So even though both of them represent the same company, maybe GOGL is about 2 to 3% cheaper than GOG. And what he did is basically do an arbitrage play by selling GOG, and buying GOGL instead. So overall, his portfolio trims makes quite a lot of sense. And I believe that there's nothing much to comment about Bill Ackman's portfolio. And I hope you guys enjoyed this video. If you guys did, do consider subscribing.